Rob's Child. Nothing I say is investment advice, and I have no intention to replace any content of security analysis, but to open it for discussion. This is on Chapter 52, Market Analysis and Security Analysis. If you've been reading along with me, congratulations, you've made it to the last chapter. It was a long journey, but we finally made it. My first reaction to reading this chapter was I kind of wish, especially the second half of this chapter, was sort of at the beginning of the book, just to give a little bit more parameters regarding what security analysis is all really for. But I guess he didn't want to spoil the ending or something like that. Let's go through the points. First point, the media, financial media, prophesizes markets. And this is in regard to, market analysis versus security analysis. The name of the book is Security Analysis. The first part of this chapter, anyway, is about relating how market analysis fits into that. So just regarding the market as a whole. The first question brought up is, how useful can market analysis actually be? And he says that if you've been in markets and listening to people like I have and learning as much as you can about this, it's pretty obvious that being able to predict market movements is a lot easier. Well, it's a lot more potentially profitable, and in some ways it would make your life a lot easier if that's all you really had to do. And so the point being made is that if market analysis can be real and accurate, then security analysis would be a lot less useful than market analysis, if that was the case. So we go through lots of points here. So he says there's two types of market analysis, really. Number one, the past, which can be studied using various charts, and that's what, chartists do. They use, what normally happens, therefore, what's going to happen. And so you use the past to predict the future, naturally. And then the second type of market analysis can be done through all sorts of economic, business, money rates, political outlooks, these kinds of things. And I'll add to that demographics, geopolitical events, etc., etc. All the stuff, all the headlines you see on CNBC, Yahoo Finance, Bloomberg, etc. And then he says, so today, as in 1940, it's really a combination of the both, using charting and news. And that's what market analysis is all about. So then he lists the 4 points, the four conclusions that he's making regarding, I think, charting mostly. So, and I'll quote, number one, chart reading can't possibly be a science, and he details the reasons for all four of these. Number two, it's not proven to be dependable. Number three, its theoretical basis rests on faulty logic. And number four, its popularity is due to certain advantages it has over haphazard speculation, but these advantages tend to diminish as the number of chart students increases. And that last one is really huge. If you haven't heard other people talk about this phenomenon, it's very obvious when you think about it. We'll get to that point. He discusses each one of these 4 points. So, funny enough, that fourth point he kind of uses in the description of the first point a little bit to some degree. So he says basically the dependability of predictions causes humans to invalidate them. And yeah, since we're already on that point, let's talk about it a little bit. So the point being is that as soon as, let's say there's a certain pattern that plays out and then something happens after that, like all the time, like 100% of the time, let's say. Well, let's say finally everybody knows that that's going to happen. Well, what's going to happen? Well, when that pattern first starts forming or is completed, all of a sudden, everyone and their brother is going to do the same thing, short or go long, in whatever pattern emerges. And when everybody does that at the same time, well, you can't do it all at the same time. Someone's always going to miss out. And then you have to rely on getting in a little bit too late and getting out a little earlier than everybody else so that, you can take advantage of this, pattern that played out. And, it nullifies it. It makes it useless. And so that's more hilarious to me. You have a lot of YouTuber channels discussing chart patterns and how to use them and, what the pros are doing and all that. And it's just hilarious how, if everyone was to adopt their strategy would not work anymore. It can't work anymore if everyone agrees to it. So, if you have a charting, I think my takeaway from that is that if you have a pattern that seems to work all the time, don't tell anyone. Just use it for yourself. And that gives more credence to making fun of all of the advertisements you'll see on YouTube and such about, how to trade options, how to, make, obscene amounts of money by trading stocks. All you have to do is use this special magic formula. It's like if they had the special magic formula, they'd be a trillionaire, and they certainly wouldn't be sharing it with you for $25. That's for sure. Anyway, moving on. He says even back then in 1940, he says chartists admit that their success is within people not knowing what's going on. And so, all of this discussion makes me think for myself, well, what about old forgotten charting methods? What about methodologies that used to work a long time ago and now are no longer, applicable to today's charts? Maybe those will work again, Maybe I should go test them out and not tell anybody. See if I can get my advantage that way. But I digress. Then we come to a point on comparing it to horse racing, how you can study how to win, study the diet, the temperature, every single little statistic to try to win horse racing. And people have done that, and people still do it today. But he says, you can win, but not often enough to make it profitable. Found that interesting. And he says that's the same thing with finding and using chart patterns. It's, you can win, but you can't win enough. You can't win frequently enough. You have to have a high enough frequency of wins and a low enough frequency and size of losses. It's size and frequency, really, of losses and gains. And then he humbly admits that, it's actually a little similar to, admittedly, using past earnings on with security analysis. That's your determination as to predict, determining what the future might be. But his big argument to say, well, what sets me different from the rest is the margin of safety. And that can be used in security analysis, and it can't be used when trying to use chart patterns, for example. The next big point I want to highlight is how he mentions that the best charting data is actually over very long periods. And one of the problems with people that are chartists is that, or people that use charts or follow charts or whatever, that people are generally too impatient for that. But he does give some credit to that, some credence to the fact that there's business cycles, the fact that interest rates sometimes seem high and sometimes seem low, the fact that PE ratios sometimes seem high and sometimes seem low. Those cycles. And before 1996, like the PE ratio cycle, it stayed, like I've said in other of my videos, between about 7 and 20. And it never really went outside of there until 1996. Since then, all of a sudden, we see it going up to 100. And, over 20 is no longer supposedly an issue. I have an issue with it, and actually that's a big thesis for myself being extra cautious right now in the beginning of 2024. But again, I digress. Moving on, the plausibility in using chart patterns is to cut your losses short, which you always hear about. Even, Gareth Soloway talks about having a tight stop loss. So, you lost and get out before you lose more. And then, letting profits run. Those are kind of the two ways of doing it. Even Ira Epstein in his videos too, it's the same thing. It's all about buying the dips when something's clearly like just going to the moon. Every time it dips, you just buy it and sell it when it goes up. You just ride the wave going up. But he says, like in roulette, the many small losses tend to nullify basically the few large gains that you might get. And so you can't really get a dependable advantage in that area. And so, yeah, just like in roulette, it's the same game. The many little losses tend to nullify the once in a while big gain. And then he re-mentions the fact that, as chartists' methods gain popularity, the losses increase and the gains decrease. And it's just a natural part of the fact that, look, I mean, even with Gareth Soloway's, his trading methods, if he's like in, let's say, a small stock and he's got thousands of people watching him and he sees a pattern, it's like, well, me watching this, I'm just one little guy out of thousands of guys that are watching this right now. And it's like, well, I'm gonna want to get in before everybody else, but I'm sure as heck gonna want to get out before everybody else too. And then and then the more popular it gets, the more likely more people will engage in that kind of behavior until your margins are shrinking and shrinking and shrinking until they're, a quarter of a penny by AI machines right across the street from, the New York Stock Exchange. Actually, I know someone that works there, but anyway. So he does give a little bit of credence to the idea of market forecasting, and he says specifically, we believe, him and I always say, Graham as if he's one person, but we is the two authors of the book, him and Dodd. We believe that market forecasting is an art that requires talent, judgment, intuition, and other personal qualities. I found it especially interesting that he suggests that you need intuition for this area, because he advises against using your intuition many times throughout the book, that this is not something that you can do successfully. Moving on altogether, the idea of market analysis is subjected to the appraisal of experienced judgment. So then we have a section on mechanical forecasting. On mechanical forecasting. This this was a really funny section to read. So he writes about blast furnace theory, which apparently someone a long time ago figured out that securities are at a bottom when blast furnaces go cross the line from above 60% to below 60% capacity when they're operating. And then that stocks are at a top, they're at a peak when blast furnaces are above, when they cross back above 60%. And so, as silly as this sounds, it worked, apparently, at least from a historical perspective in that time. And again, I'm just thinking about myself, knowing about certain patterns that have played out over and over again throughout history, and how everyone and their brother right now is expecting a recession. With the yield curve massively inverted and all of these things, and so it naturally makes me wonder if there really will be a soft landing. Number one, which is the most boring and seemingly most probable scenario until everyone accepts it, and then we'll end up in the first depression since the 1930s, right? But anyway, again, I digress. So in addition to that blast furnace theory, I just love the sound of that, blast furnace theory. Maybe I should start a YouTube channel using that, blast furnace market analysis. I don't know. So the other one was even funnier. A high point in bonds, he found, tended to be 14 months after the low in pig iron production. And stocks also peak 2 years after the low point of pig iron production. So there's your next indicator, the pig iron production indicator. And I mean, this relates to so many, indicators today. There was one more recent one that all of a sudden everyone was talking about, and it's just funny. It's funny, right? As soon as everybody knows about any of these indicators, it kind of takes away the advantage of anybody that was using it secretively. I love that point. I love thinking about that, and just considering for the future, the pig iron theory was not the last theory for people to come up with, and we're always coming up with new ones today that we can take today and look back for 20 years and say, oh, look, every time this has happened, this happens afterwards. I mean, granted, he even says in here that, when interest rates go up, it's pretty easy to predict that there's going to be a downturn in stock valuations and the economy and everything. But again, that's a longer game, and the question is, well, how long exactly? And the big idea today is that after the yield curve uninverts, that's when you typically get a recession, and it's been foolproof for a long time now, specifically between the 3-month and the 10-year. I think it was Lynn Alden that first brought that to the table, as far as my knowledge goes. And now everyone knows it. And they always talk about it on their YouTube channels. And I'm thinking, the fact that the pricing of these markets are controlled by such a small percentage of people, these are the same people that are watching this. This is me. I'm the guy sitting here with everybody else expecting the yield curve to uninvert, and then within 6 months, deep recession and market crash, right? And so I found this chapter to just be very enlightening, especially in regard to the possibility of a lot of charting predictions today to potentially be moot points, to be no longer valid. and partly because of the popularity of them and the knowledge of them. But moving on. Yeah, it is at this point where he states it's easy to predict a market decline after high interest rates, but he asks, so how soon? And there's no scientific way to answer this. Again, like right now, the cycle, like if inflation ticks up again, we could see another raise in interest rates. And then all of a sudden, the bond yield has to go up. I mean, who knows? Maybe the 30-year bond will get to 10% before we finally see, inflation going down enough for the Fed to want to cut rates. I mean, and that's the other thing with the end of the Fed. Supposedly the Fed doesn't really have control over any of this. A lot of people. Anyway, that's another discussion. Let's stick to this chapter. I'm going to be making a lot of videos once we're done with this series, which is right after this video. But I digress. Let's move on. I wanted to note in this part of the chapter that he defines scientific as entirely dependable. That's not exactly what science is or means, but it's important to realize that's his definition of what is scientific. And then we have a part where he alludes to the idea that ability and knowledge can give you success in security analysis and using it for profit. And also there's a little bit of an art to it, he says. But when you're talking about market analysis being successful, that it's purely an art and requires special talent and, the list of things that he mentioned earlier. And then we have a major point, again, in the entire purpose of security analysis is to have a margin of safety so large that that it doesn't matter if it doesn't work out. And that market analysis does not have any margin of safety. And that's really the big advantage that you can have with security analysis over any kind of market analysis. There's a point here made as well that active trading is very expensive. Not anymore, Graham. It's free. Your broker, they don't charge you anything anymore. There's no commissions. There used to be commission for anybody that's really new to this. Just to buy or sell anything ever they used to charge you like $8-10, something like that, for each trade. And so for anyone actively trading, it costs money. And then and that cuts even more into your potential profits when you're trying to cut your losses by the smallest amount and take profit. So again, there's more efficiency today, and trading is essentially free outside of the little bits that the market makers can make on little tiny inefficiencies. Moving on, he also says that so active trading is really in essence of a battle of wits, and that it's not. I think he sees it as a game not worth playing, basically. And anyway, moving on. Next point, he reminds us that security analysis is very difficult, and it is rare to find great opportunities. This is something, again, Warren Buffett talks about all the time, how it's almost impossible now to find great opportunities because of how efficient and smart people are. And I think it's going to, in that same vein, is likely to get worse with AI being involved. I mean, it already is, but it'll probably continue to progress in that direction. I wanted to read a quote from 721. There are no dependable ways of making money easily and quickly, either in Wall Street or anywhere else. And again, the most accurate patterns that you can predict out take a very long time. Business cycles are typically, in this time, 7 years was like a normal full business cycle, for example. And still today, I think it might average out to be around there. And and so that's not quick. It's more dependable than a lot of the chartists methods that are out there. But I thought that was an important, good quote to mention. Then we have a point that says the current market price already takes into consensus of opinion as to future prospects. And this is especially important when you, as an individual, see something at a price and you think it's the wrong price. Well, it's that price because that's the consensus. That's everybody that was interested in this or that is interested in this has voted basically that this is what it's worth. And that, if you're trying to get a gain by having some kind of knowledge over future prospects of a business, of an industry, or of the whole market, that's generally probably already priced in. And because we've already voted on it, it's already is what it is. And so the downfall of forecasting business prospects might be wrong. And if it's right, the price might already, it's probably already priced in, like they say. And then he talks about, I think, two big mistakes that this really important advisory company made, basically trying to predict the future. Then it was a huge error. Just trying to put the last nail in the coffin as to regarding people trying to predict prices, especially short term. Then we mention, it's better to stick to these 4 points. And this really kind of sums up the whole book, I think. These 4 points is, in order to be more successful than someone speculating on the markets, number 1, you can use the selection of standard, and I quote, number 1, the selection of standard senior issues that meet exacting tests of safety. Number 2, the discovery of senior issues that merit an investment rating but also have opportunities and an appreciable enhancement in value. So in other words, like senior bonds with convertible bonds, something like that, obviously. Number 3, the discovery of common stocks or speculative senior issues that appear to be selling at far less than their intrinsic value. And number 4, the determination of definite price discrepancies existing between related securities. He didn't go into that much in the book, but that's the last section. Which situations may justify making exchanges or initiating hedging or arbitrage operations. And that's what this whole book is about. It's those 4 methods of using security analysis to give yourself an edge on figuring out how to dependably make a good profit. All right, and then we end the book. Really, that was probably the end of the book, because I'm not sure why he didn't just separate this into a separate chapter, but this last section, the subtitle, a summary of our views on investment policy. I found this to be really funny because it is exactly the same, if you remember, all the way back from the very beginning of the book. The very first subtitle of the introduction is Problems of Investment Policy. And the very last section of the book is a summary of our views on investment policies. So, he presented a problem in the beginning, and now it's fixed through this 727-page book. All right. So he starts off with the investor of small means and says, well, here are your three options for everyday Joe. For income, he says that the only sensible investment is savings bonds, or he will likely regret it. Now, I think it's important to put this in the context of the fact that this was pretty soon after the Great Depression. And I think Graham is kind of assuming that Great Depressions, they were common before the Great Depression. There are many depressions. And I'm assuming he was thinking, well, surely there's going to be depressions moving forward in the future. There hasn't been one for about almost 100 years now, and that's what partly makes me think, well, geez, maybe we're due for one at this point. Actually, this idea that we can't ever have a depression again, is that actually true? I don't know. Guess we'll see. So from that perspective, though, the only sensible investment is savings bonds. So that's pretty interesting. Not even like, corporate bonds of the highest grade are advisable for income purposes for the small investor. So then his second, the second thing a small investor can do is investment for profit. And he says, buy stocks when they're cheap, when the market is clearly low. And so for me, that would be the equivalent of the S&P 500 trading at a PE ratio of 7, as it has done many times in the past. And I'm expecting it to come back to that valuation at some point within my lifetime. I don't think, and it just has to do with the fact of earnings power, like, in the meaning of PE ratio. Like, it's once you get above 20, there's no safety. There's no margin of safety. And for all these mega caps to be trading at, very high PE ratios, 75, for example, or it's gotten out of hand, in my opinion. And, when it comes down to it, when we really do see the tide going out and people have to be more sensible with valuations, it's going to be a bloody mess, in my personal opinion. Again, no investment advice coming from this channel, purely entertainment value. Anyway, so buy when the market's clearly low. Another thing you can do is buy special growth. He notes when growth is expected, price is usually actually too expensive. And so, all these growth stocks, the Cathie Wood, now that she's a celebrity, these things might be overvalued and continue to be overvalued for a while until the stuff really hits the fan. But again, on personal opinions in that area right now. But and then if the public has little or no confidence in the growth of a company, it's a two-pronged, he calls it a two-pronged issue, that it can either be very profitable if you win, or it can turn out to be a big loser because, it's cheap because everybody else saw why it was cheap and you didn't. So anyway, moving on. Next point is that, you'd be well advised to to buy well-secured privileged seniors. So senior debt of a company that has convertibility, like, these are super attractive, because if the stock price goes way up, the value of your bond goes way up, and if it's super safe, then you're never going to lose any money either. That's like obvious choice for a good investing practice. And then another way that a small investor can invest for profit is buying well below the intrinsic value. And this includes finding bonds, preferred shares, and common stock in those categories. So, and then we have a cool little point in here where he advises the little guy to submit his ideas to the pros, basically. The official statistician of the New York Stock Exchange or something like that. And he states that there's logic in the fact that if you can't advise other people, why should you advise yourself? Like, you're not a pro. What are you doing, little guy? And he says, well, I'm not totally bashing you, little guy. I'm saying, modesty has its place alongside self-confidence. So you talk about psychology of investors or anybody in any field. Those two things don't have to be exclusive. You can be modest and you can have self-confidence. Delicate balance, I reckon. And then we have a section on how the small investor can speculate in markets. And I was going to quote the first sentence of 725. And I quote, "The investor of small means is privileged, of course, to step out of his role and become a speculator." And then here's the funny part. He is also privileged to regret his actions afterwards. That was really funny for me. So, and he basically he says, he condemns with emphasis that the small investor should be not buying new ventures, stock in new ventures. And it makes me think of the, let's call it the 420 industry. That's a new, I count that as a new venture that I'm interested in. And also maybe Bitcoin miners, these kind of things. They're kind of new, kind of becoming more popular. And this is that area of speculation he condemns with emphasis. And then part B is basically advising, I believe, against trading, in that everyone pretty much fails if they're trying to catch swings in the market. Again, I think for the same reasoning that, even a professional trader will have a lot of difficulty with, making their losses so infrequent and small, so small and with low amount of frequency compared to their gains, that they need to have that in order to be successful, and that's nearly impossible for everybody. And then that buying growth stocks is dangerous, but it has potential. And out of the three ways a small investor can speculate, buying growth stocks is probably your best option out of your choices. Almost done with this. So the next section is individual of large means, and he goes through the handicaps that a large investor has. And the first one being that you're only allowed to purchase a certain amount of savings bonds. Things have changed a little bit since then, but that's another topic. Number two, the inflation hits him really hard, and so in that regard, stocks actually function as a defensive mechanism for his buying power, essentially. And then number three, the large size makes him more attracted to popular and active stocks, and he won't generally participate in undervalued securities. I'm not sure exactly why that is. Maybe it's because they're a large investor to begin with, so they don't think they need to bother, trying to find the cigarette butt stocks that Graham loves and tries to take advantage of. But he says, the bigger problem is generally his prejudices and his preferences, and those are the three handicaps that they experience. And I thought he was going to go into more detail there, but I guess, in the smaller investor section, like, he covers pretty much all the basics. And again, the section right before, the most important part of this book was those 4 points that we mentioned earlier. And then, so then we have a section on investment by businesses. So if, how is a business supposed to invest their money? And, if they have with their cash, really, if they know they need to have it sitting around, he says, basically, T-bonds only. Don't mess around with anything else. And that's pretty self-explanatory, risking safety of the assets of a business is, adding risk to the ownership of all levels of the capitalization structure of a corporation. And so it makes sense to have only T-bonds be a part of that structure. And I don't know if, businesses today still generally do that. I think they generally do, the money market accounts at the very least for the most liquid cash that they need available. And right now, with the yield curve inverted, that's the best place for your money. You can't lose with that. Moving on, the last section of this section of the chapter and of the book is for institutional investment. And so he says that, it's their business, so they don't want to give policies because, it's expected that an institutional investor will have their own policies that they stick to. But in general, he says, still, with that said, it's best to stick to high-grade fixed value securities. He notes the fear of stock indexes. Again, this is somewhat reactionary to the Great Depression. Today, he might think differently. He might not. He might be in the camp that we're overdue for a depression. I don't know. But, and then he notes the last point of this is that he will change his view if inflation is guarded against or the income of the institutional investor is too low. In that case, some money can be used, in either of those cases, some money can be used for investing using all of these methods in the book through security analysis to take advantage of situations and use security analysis for that. I wanted to just mention that it's interesting, his view, if inflation is guarded against, and how the Fed guards against it, right? And it was Bernanke in the 1970s that supposedly made the biggest error of not raising rates high enough, fast enough, and then they finally did it. They finally beat inflation. And, you listen to Jeff Snyder and a lot of people that want to end the Fed, they're saying that, the Fed really had little or nothing to do with it. It has to do more with the demographics, the baby boomer generation, and that there was no stopping inflation in that period, that, there was really nothing that could be done. So, Graham noting here that, if inflation is guarded against, well, we're trying to guard against it, but it has already proven to not be guardable against in certain cases, in certain scenarios. Also, moving forward in the future, if, the United States loses its world reserve currency status, and or if, another country seems like it's a better place for all the foreign countries to, that's their safe haven. Right now, the U.S. is the safe haven. The U.S. dollar is the most dependable currency on the planet still today. And, that could change at some point, but that helps guard against inflation as well. But if we were to lose that, then it could be more problematic going into the distant future, if it ever changes, right? I mean, maybe, who knows? Maybe the United States will still be, will still have the world reserve currency in 1,000 years from now. People have been predicting the end of that for a long time, and but I digress. That's it. That's security analysis. That's the end of chapter 52, and that is the end of the book. If you watched this series, if you read along in this book with me, I hope you enjoyed it. I hope that my videos helped emphasize or helped you learn the material a little bit better, if nothing else, to review in your own mind, all of the lessons learned throughout this book. Admittedly, I didn't fully comprehend every single point of this book. I'm going to have to reread it, at least one chapter. I remember I had particularly difficulty with. But again, with this video and all the videos, please comment. I want to know your thoughts. I hope that this can be a place on the internet where people can discuss each chapter of the book, like I said in the introduction of this whole series. And thank you for watching. Rob's Child.